Hello and welcome to the Monday Futures Market Outlook for February 4th, 2013. This is Patrick Serezna. For those of you that have not had the opportunity to try out our eMiniSource.com trading room, complimentary memberships are available on the website. All of the intermarket analytics that we do throughout the session are available in writing in our Market Timing Strategist newsletters. As always, we start off with a chart of the US dollar index futures. We were suggesting over the last few weeks that there was room for the US dollar to deteriorate down to the bottom of the range of the 2012 lows around that 79 level down below. But we weren't anticipating the US dollar to further weaken here at this juncture. And one of the reasons was our outlook on the euro, which has now overextended on the upside and has plenty of room for short-term corrections. While we don't want to suggest that the US dollar cannot go lower this year, we do not believe, at least at this juncture in the next month or so, that is going to happen without some new catalyst coming to light. At this stage, likely support here, and we could gravitate more towards the top end of the range of the last few months, back around the 81, 82 level in the upcoming few weeks or months. Next year, I want to take a look at the euro futures, and the euro dollar has progressed substantially higher, even exceeding the 2012 highs, hitting a high of just over 137. This, while it was an impressive move, this is now what we call an overextended move, and there is now plenty of room for the euro to consolidate off these highs. And while maybe there could even be short-term spurts up to 138, as far as we're concerned, there needs to be some material backfilling in the euro. It would not surprise us if we started seeing a drop back down to even 133, 132, 131 on the downside. We do not believe that this necessarily has to equate to a new downtrend in the euro. Simply, the euro has overextended to the upside and needs to spend a considerable amount of time now creating a base or consolidation from that rally. And so we're looking for some weakness, and that subsequently will lead to some short-term US dollar strength. Next year, I want to take a look at the 30-year Treasury bond, and Treasury bonds have continued to consolidate to the bottom end of ranges, if not actually having even broken to a lower low than the September lows. This is something that we're paying attention to. Our first outlook was that the Treasury bonds are likely to bounce off this support, and there is still a chance here at these levels that the Treasury bonds can hit a bottom and bounce, but it would be a substantial technical event if we deteriorated below this 143 level, give or take the zone, and actually held and consolidate at lower levels. That really at that moment would instill, rather than a sideways range-bound Treasury bond market, to actually a downtrending Treasury market, and that may build upon itself in the upcoming months. We at this point still do not want to suspect that breakdown is officially started, and we do think that there's room for a bounce, and so we're going to watch to see whether or not this week the Treasury bonds can muster that up here. If we see weakness in the euro, weakness in the stock market, Treasury bonds can bounce. Next, when we take a look at some of these commodities, copper has had a break up higher. We're now seeing approaching those highs that are put in that September-October period, just literally being 5-10 cents away. We do believe that will initially be the overhead resistance, and there would be room for copper to consolidate off those highs, but we do not necessarily believe that copper will be bearish here beyond proper pullbacks. And so we're sort of looking at this copper picture more that we're in the top end of a trade range, which makes it a very mixed picture, being long copper up at these higher levels. Similarly on crude oil has had a really nice run. We've seen that short-term bottom put in back in November, December along the $85 level, and since then we've seen oil work its way higher. But we do believe that there's plenty of room for there to be a material overhead resistance along those September highs, no different than copper. And therefore, we only, while we're not necessarily bearish crude oil, we don't believe that there's much more short-term upside, and there's plenty of room for there to be backfilling and pullbacks. And so while we certainly don't want to rule out the possibility that we could have a 2 or 3 day rally that comes and tests that 100 level on the upside, but really at this point we think that this is like the 8th or 9th inning of this crude oil short-term move, and there's plenty of room for consolidation going forward. Next here, I want to take a look at gold futures. And unlike a lot of the other commodity spaces, which are very mixed and have poor risk-reward propositions, gold is consolidating at a pretty interesting level. We continue to have an outlook that is bullish on gold, but where there is absolutely no denying that gold has yet to give us anything other than a support line to be optimistic about. While we've continued to believe that there is plenty of room to be bullish so long as 1650 holds, really at this point we do need the gold bulls to come in there and actually prove that gold is going to go higher, and we see some price action confirmation that it is rolling up. The longer gold stays in this level and consolidates sideways, the increasing likelihood that there could still be a step lower. And so really at this stage we remain bullish. We think that the support is important, but if the bulls fail to actually reverse this and break it above 1700 and build some momentum, we will become increasingly concerned that we'll have to change our view on this. Finally, I want to take a look at the S&P 500, and when we take a look at the market, we clearly have a market that has now advanced to the 1500 level and is putting in some overhead resistance up at these levels. We at this point cannot rule out even a bigger measured move that even goes up to 1550 on the S&P, but really at this stage we find very little interest or value in remaining long the S&P 500, while we have very little interest also in accumulating shorts until there's a clear topping formation and reversal in place. We do believe that this is a zone from which investors should be proactive profit takers and reducing risk in portfolio. At some later stage there might be room for catching a short on the downside, but we don't at this point feel that that's something that we want to advocate, but active profit taking we do. Just to review our key intermarket observations, at this stage, while in the much bigger picture we do see a lot of shortcomings in the US dollar trend, on the short term though there is support, and there's lots of reasons why there's room for the US dollar to actually pop off these lower supports. And so the short term risk reward actually is good in owning US dollars, but do not mix that to a long term outlook. When we're going to commodities, other than potentially gold having room to go, we have a very mixed to range bound kind of outlook where commodities are now at the top end of the ranges, and we at this point feel very little motivation to want to chase many commodities other than dabbling with gold here. In terms of US bonds, we think that risk reward is average at this point. If that support held, we would actually be quite eager to switch that to even a good risk reward proposition, but really at this stage, because we still have yet to have any proof that those bonds will hold that low, we're going to just leave it at as an average risk reward proposition. But if you see bonds nicely rolling up, particularly if it's shifting with currencies and stocks at the same time, that we could become bullish on US bonds, but still premature. In regards to stocks, both U.S. and global stocks, we've had an amazing uptrend in place, but these moves are finishing, and we do have these completed measure moves on the upside with already material rallies at this stage. That makes the risk reward proposition of being in the stock market poor. Even if the S&P is able to make another 2 or 3% progress on the upside in the short term, the risk of staying in the market to try to gain those few percent is, in our eyes, is not worth it. And at minimum, if you do have a fully invested portfolio, it would be worthwhile exploring the potential of hedging the downside risk of your portfolios. That was your Monday Futures Market Outlook. Thank you for joining me.